Good day and welcome to the latest webinar in our series from Talking Hedge Events. Our Toronto 2020 series continues with another great session. I'm going to hand things over to Meg Bodie, the founder of Talking Hedge Events, to lead us into our topic.
Thank you, Ken. Thank you very much. And welcome, everybody. I can't believe it. It's our fourth webinar already. We have a terrific discussion on dislocation of assets, which is actually challenging, but often presents an opportunity to investors. And so that's what we're going to dig into today. I want to thank our panelists, Jane and Danilo and Kunjal and Jean-Francois for being with us. I want to thank Lixor for making this possible today. Also thank Aspect Capital and State Street's InfraHedge division and Efficient Capital for supporting this summer series. We think we're going to have a couple more coming your way, but why don't we get into today? One caveat is I want to mention that when we're in person, we operate under Chatham House rules. Makes it a little challenging for today, but I do want to note that we should not be quoting anybody. Their comments are their own, not necessarily the opinions of the organizations for which they work. And this is the way we keep everything between us all here today. So I'd also like to just give a brief shout out. Hi, Kunjal. I'd like to give a brief shout out to our association partners, Ema, Kaya, and Casa. And now it's my pleasure to invite everybody on the panel to pop in. I see Kunjal Shah, the CIO of Lixor, who's going to lead this terrific discussion today. Danilo's here, JF. Jane's having a couple of technical issues. We'll try to get her there, her face there for you in a few minutes. Maybe not, but we have her voice. So anyway, Kunjal, take it away.
Thank you, Meg. And I wanted to thank the panelists as well for agreeing to be on this panel, and thank you for everybody attending. So what I wouldn't mind doing is turn it to the panelists so they can introduce themselves. So we'll start with Jane. Maybe Jane, if you could provide an intro to your background, your organization, and your role. And then we'll transition to Danilo and then to Jean-Francois. And then I'll provide a quick intro to myself.
Of course, yes, and apologies for the camera not working. It was working up until about 5 minutes ago, but here we are. So I work at the Healthcare of Ontario Pension Plan. I joined in January, and the External Managers Platform is a relatively new initiative at the fund. There was a couple allocations prior to me joining, but very small, and the plan is to grow that platform up to about, maybe close to 5% of fund assets over the next 3 to 5 years. So a lot of support for external managers. And we can speak to how they've been showing that in the past little bit. I joined Hoops from the Ontario Teachers Pension Plan, where I was for just about 5.5 years.
Good morning, everybody. Danilo Simonelli. I run the external manager group within capital markets at Ontario Teachers. We're really responsible for 3 different areas within the fund: a long-only equity platform, a long biased credit platform, and a hedge fund platform. All 3 mandates are global in nature, and all 3 mandates are really meant to be accretive to the overall asset mix of the fund and generate return through different cycles at different points in times.
Hi, everybody. I'm Jean-Francois Tormeau. I'm Senior Portfolio Manager and Head of Portfolio Solutions in the Americas for Lixor. I've been at Lixor for 16 years, making me one of the dinosaurs there. 10 years in New York. Prior to that, I had a few experience on the sales side. So at Lixor, I'm a Senior Portfolio Manager and Head of Portfolio Solutions, which means I'm responsible of the mandates or the discretionary portfolio of hedge funds, advisory mandate relationships, and in terms of what type of return characteristics, that ranges from absolute return programs, solutions which are more customized to investor needs, and the last bucket would be more opportunistic type of solutions.
Excellent. So my name is Kunjal Shah. As Megan mentioned, I've been at Lixor for 6 years. Work very closely with Jean-Francois Tormeau. and also with some of the clients that are dialing in and on this panel. And as Jean-Francois mentioned, the key functionality is hedge fund advisory, where we use hedge funds create customized solutions, but we also use hedge funds to create managed accounts for large institutional clients, and also use them to create a usage structure for distribution in Europe and outside of Europe as well, as the structure is gaining traction there. In total, in aggregate, between the different platforms that Lixor has, Lixor as an organization has 160 billion of assets. And the active side of the business is half of those assets, 80 billion, and of which roughly around 30 billion are in hedge fund structures, whether managed accounts directly or UCITS. So maybe with that, I will start with the panel. We do have pretty interesting markets, as everybody's been through. March was one of the biggest dislocations that I've seen in my lifetime, and I've witnessed 07, 08, 09. And it was also the fastest dislocation. We got a massive dose of stimulus, fiscal and monetary. So maybe we'll start with Jane here. As you look at the markets today, whether different asset classes or geographies, where do you have concerns about valuations? Maybe we'll start with Jane and then go to Danilo and then Jean-Francois.
Yeah, I think the common theme across assets right now is that they're being largely supported by the central bank. So when it comes to valuations, as you mentioned, I mean, the dislocation was very quick and very big, and was met with a very quick and very big support globally. And to say things are overpriced or underpriced, it's, that the recovery has been priced in. So these assets are where they are because of the support they've been receiving. And the question is, what does that support look like, and how long can it be held going forward before it starts to run into limits, whether that's inflation, whether that's loss of faith in the currency. So I think that, across the board, you just need to be a little bit cautious. I think that dislocations are going to continue to pop up in credit, as this story plays out and as more pressure is felt by industry, we're going to see more dispersion in credit. And there are so many factors on top of this pandemic that are affecting the economy right now. I think that we're going to have a very volatile, next 12 months. In the short term, as I mentioned, you have the support from central banks that kind of is stabilizing things. But with the U.S. election coming up and all of the factors around that, what equity markets are going to look like in the next 4 to 5 months, I'm not sure. So to say, they're overvalued, I think that would be a strong statement. I don't know if I can stand by that at this point, but I would just watch for credit dispersion and more dislocations in the credit markets to come up.
I've seen many people quoting the now famous cover of The Economist from a month and a half ago, give or take, which had the Wall Street and Main Street kind of like diverging and like going into different paths. And I think that's a very easy way to represent the situation right now. But I think there are so many nuances even below the headline of that story in terms of the speed at which this kind of dislocation are actually going to play out. And so on one side, I'll echo a lot of the stuff that Jane has said. When you have that strong support from fiscal and monetary authorities, I don't care which valuation framework you use. If you're using a discounted cash flow, if you're simply looking at demand supply in specific asset classes, clearly valuations are supported by a ridiculously low rate, commitment to keep those rates at those levels forever, and so on and so forth. But we're still seeing bankruptcy going through the system. We're still seeing real companies, and these are not just like mom and pop little shops. These are like sizable companies that are going through real cash flow crunches. And it can be anything from their supply chain being disrupted to the fact that nobody's buying their products anymore. And I think that's going to take a long period of time to flow through. I don't think it's going to flow through in an even way. And so I think actually fundamental analysis and being able to get deep down and looking at within your equity compact who are the winners, who are the loser. Within your credit group, who are your winners and loser is what really going to be matter going forward. Doesn't necessarily mean it has to be done in a discretionary fashion. I think there are a lot of systematic filters you can use to figure out where those winners and losers are coming out. But I truly believe that old school balance sheet analysis and looking at what's going on is going to be what wins the day from here on.
Yeah, I think agree with everything which was said. It's true that if you look at just looking at the balance sheet of the Fed in the US, growing from 4 trillion to around 7 trillion now. What's interesting is, and probably not a pure coincidence, but the Fed balance sheet is starting to stabilize and actually going down in July. And if you think about the performance of equity markets June and July, to trade in a range. So it tells you that you are getting to that point where it's getting priced in. You're also seeing less support to some degree, even though it remains pretty large. So I would not fight any of those flows. But clearly, you need to watch at this evolution of the Fed balance sheet, because you add this very high correlation in terms of equity markets. The comments I would add also, which shows that many of us keeps on having this uncertainty and seeing the disconnect between the real economy and financial markets. One way, by the way, to add on that is financial markets are looking forward, and you are looking at the real economy. And if you think about real rate or rates being at zero for the foreseeable future, no matter what earnings are going to be, they will recover to some degree. So that puts the framework a bit better. But if you look at a number of assets such as gold, which has been at 20% this year, real rates are negative. Volatility is still very elevated. The VIX is around 30. So very unusual to see markets recovering and the VIX trading at actually twice of what is the historical average, not even looking back at the historical lows that we've seen years back. So that tells you that you have these uncertainties in markets, and what that means when you have such a disconnect, you'll have some volatility going forward. And one way or the other, financial markets can go down a little bit, or the real economy can actually catch up. And that's maybe not the top scenario, the highest probability scenario right now, but you have also potentially that upside scenario, which is not necessarily priced in to some degree.
Excellent. So I'm actually going to put in some of the questions we're getting and the questions we had, and to some of the comments that Jane made, Danilo made. So one question I have is around dispersion of credit. So in my mind, when people talk about credit, I break the world up into a matrix. That's how I work. Is you have corporate credit, IG, high yield. You have structured and securitized credit, which is CLOs, RMBS, CMBS. And then at the top, you have US, Europe, and then emerging markets. Really, it affects IG and high yield. So when you look at that matrix and dispersion that Jane brought out, and also maybe adding some poetry from Danilo, who was talking about fundamentals. And one comment we keep on hearing today is cash burn. What is the cash burn of that industry, which is a more fundamental analysis. How do you think about where there's opportunity? Where do you think maybe things have run up a little bit quicker, but there's still opportunity where there's a lot more opportunity? Maybe if you could start with Jane, if you use that matrix as a framework, or if you don't want to, that's fine. But maybe if you could go through that in a systematic manner.
Yeah, I would say across the quadrants, there was opportunities through the first few weeks of March, prior to the majority of the stimulus being announced. And once the stimulus in place, there was a lot of spread compression, and had you not taken advantage of some of that dislocation through March, it did go away very quickly. Longer term, I think that there will be opportunities in, structured credit, private credit markets going forward. And I think that you're going to see, the geographic dispersion as to where that opportunity is the strongest. And part of that is going to be how countries come out of the recovery and how their fiscal and monetary policies adjust to that. Our current view is, we're looking at different pockets in Europe, watching Asia very closely, but, the US right now is still in the thick of it. So I don't expect to see opportunities of the same quality in structured credit, for example, that we saw in March for a long time in the U.S. I think a lot of that has been compressed. In more esoteric areas, there was some really strong opportunities in the municipal bond market and in the converts market. And those are kind of two areas that we've chosen to focus on. It's a great complement for our book. Those two asset classes aren't covered extensively internally. So we're able to leverage our external managers program to gain those exposures at a time when there's, historically high, historically wide dislocations in those markets. And that's kind of, where we've been focusing our analysis over the past few weeks.
In terms of looking at credit, I think it's again a question of follow the flows and follow the central banks. You've seen all the credits which were directly targeted by the different central banks recover first. So if you think about the US, Jane mentioned it, munis have been rallying very fast. Then the Fed has started to buy mortgage-backed securities and then moved into credit. And so basically, if you look at the credit market in the US, looking at double Bs to take one rating as an illustration, high yield corporate credit price index is pretty much back to pre-crisis. So which means there you don't have that much opportunities besides indeed what Danilo was mentioning in terms of playing some dispersion. If you look at more structured credit, CLOs dropped by about 40% in March, back about to down 15-20% for the year, similar double Bs. ABS markets have been down about 15%. Recover slight, a little bit less, given that it's more tied to the consumer. So what that means is you still have opportunities in those credits. However, it's a unique situation. The works on understanding the loans, which are the underlying of those structured credits, is paramount. And what that means is you need to find the right partner to select the right papers and the right time to monetize gains as they appear. But it's true that it's been very fast, but there is more to do and clearly some opportunities in the US in CLOs in I would say more junior tranches in mezzanine, for instance, and similarly in Europe.
Excellent. So I think we may have a technical difficulty with Danilo as well. But one of the things I wanted to draw out was I think Danilo made this comment that fundamental analysis shouldn't be thrown out completely, which I would completely concur with him, because the one thing I would say that the market needs to still look at when you look at a corporate and the crisis that is impacting cash flows, ability to generate revenues, cash flows. Analyzing cash burn is, I think, one of the critical components. And maybe with that, I'll see if Danilo has questions because I was trying to fill in for him. But I was mentioning analyzing cash burns is one critical component, which ties up to what you were saying in terms of fundamental analysis and looking at the balance sheet. But maybe I'll turn over the question to you in terms of how do you look at the credit space and then by geography.
And apologies, something went horribly wrong on my system. All of a sudden, I lost audio and video, so I might end up repeating something that Jean-Francois or Jane have already said. But when I think of the matrix you set up originally, which was different level of seniority on the credit scale and geography, I will really circle back all the quadrants where I know there's a central bank authority that is really committed to that sector, and forget about those. Those things are not moving. Like, don't even bother playing around. They're going to sustain. They're going to have a nice return, but I think they've already priced a lot of that support. And so there is not that real big risk of them going against you, but you're not going to, make a killing staying in those areas. If you go in those sectors which have been a bit more forgotten, if I may use that word, that's where you probably are going to see a bit more volatility. And then going back to the last part of what I heard you say, Kunjal, being able to actually do a bit more deep dive and fundamental analysis is going to help you. I will stress that I believe we are slowly inching towards a more decentralized world where globalization, even the financial industry, is going to start being a bit different. And I think you've even seen it in the last 4 trading sessions between China and US. You have the equity markets really going into different direction over time span. So I think, again, that deep dive, looking at fundamentals, and fundamentals might simply be now, what's the COVID rate in your economy, is going to drive different potential. But there aren't that many of those boxes that are left, unchecked by the central banks right now.
So we would agree that the IG high yield market, and especially the crossover space, heavily supported by central banks, which also begs the next question, which I think you said fundamental analysis, deep dive, also begs the question around certain sectors where you want to be cautious, whether it's in credit or equities. So if I can move towards that, where are you guys being cautious when you do your work? Where do you feel like you need to be a little bit patient, don't rush into this? And maybe we'll start with you, Danilo, and then go to Jane and then Jean-Francois.
Yeah, and I'm starting to build my own theory. I haven't trademarked it yet, but I think there's a bit of a Goldilocks fear right now, in the sense that given how fast this dislocation was in March and how fast it was the bounce back, people are getting worried now both end of the spectrum. You're worried about going to something way too early and there's more damage that might come, or might go in way too late because it bounced back so fast and you can't really catch it. And clearly, the underlying liquidity of the asset is going to matter a lot. So when I look at stuff like the stressed credit, I think the cycle there is much longer and people can be much more patient. But even there, I think trying to strike that right balance between your pace of deployment is going to be really, really difficult. And you're going to make sure that if you're doing it yourself or if you partner up with somebody externally, whoever is actually doing the work is able to keep a pace which is intentionally deliberate and trying to capture the opportunity, but not too aggressive to the point where you actually end up too early into something. So I would say definitely on the distressed credit, it's an area where it makes sense. Structured credit, again, because it's not in those boxes that have been checked out by the central banks, you're definitely seeing opportunity there that are playing out. They have bounced back already. It's not clearly as attractive as it was 2 months ago, 3 months ago, but still think the pace at which the market normalizes in those neighborhoods is much slower. And especially if you're able to monetize on the new issue side and be able to actually get some of that opportunity from people who need to refinance themselves, and they need to do so at terms which are clearly more attractive to the investor than they were even a little while ago, that's an area where you can probably make some good money.
Yeah, I think from our point of view, a couple aspects that we're being very cautious are, as I mentioned, and this is a bit of a tainted view just because my background is more in the structured credit arena. But as we do take advantage of these dislocations, and that I would say that they were skewed a bit more towards credit, again, from our view, looking to complement what we do internally, just being very mindful of the credit beta that we're building. And, as much as a lot of these opportunities are idiosyncratic in the sense as to how they came about, there's still going to be an underlying credit beta that we need to manage and watch as we go forward. And what's made that a little bit more complicated than maybe it was pre-COVID is with the huge glut of, buying by the Fed, your hedge, you have to be careful how you put your hedge on, and that you don't want to be fighting the Fed and looking to hedge an instrument that they're buying and just have that erode, the P&L for the trade. So I would say that we're just being, again, mindful of the credit beta that we build and being a bit more tactical with how we apply those hedges.
Yeah, I think most was said. I'd try to find an example of a dislocation which has been attractive and that still presents nice opportunities, but not yet fully recovered, but at least to be cautious. So it's if you look at the implied assets, for instance, volatility or dividends, for instance. So you add obviously a massive dislocation in both. I was mentioning the VIX that is still trading at 30, but that's one part of the equation in volatility markets. You have curves, you have different relationships between regions, between assets, dispersion between an index and the constituents. Some of that has recovered, but those tends to be traded across OTCs, for instance, and at times we've seen in March that it's been difficult for banks to price some of those and offer liquidity and some of those products. So still opportunities, it recovered. So if you think about dividends, for instance, which went down about 50% in March, the spot dividend went down even further, but you had some regulatory pressure in Europe to cut and postpone dividends. But you have also some of the longer dated futures in dividends, which have been starting to recover and actually have been doing better and taking the lead at some point. So you still have also opportunities which are left. I just be careful of a little bit of the liquidity in some of those markets and also being mindful of the impact on other players in those markets, since you have also ramifications. But everything else, I think it's a word of caution. You have this disconnect again. In multi-asset portfolios, we like to kind of cut risk a little bit from where we are right now. Probably doing some, Kunjal, you mentioned equities, rotating potentially out of the US into the rest of the world, since the US has been really leading the charge. And within the US, obviously those sectors which are being favored by this structural secular change in cloud computing, in robotics, in clean energy to some degree, have been beneficiating from that current situation, and that will continue. So we would also keep this type of sector allocation and then overall reduce the beta and transition a little bit outside of the US and keep some of those big thematics in portfolios where probably you have more room to go despite valuation.
Perfect. And generally, as I mentioned, Jeff and I, Jean-Francois and I work very closely. Some of the areas where we are cautious about, just maybe for everybody who's listening, is some of the CMBS sectors, which may have a heavy exposure to hospitality, hotels, and also tier one malls, which are malls in tier one cities, so namely New York, San Francisco, Chicago, Boston, cities which are high density, but maybe in the past decade, those are the most desirable properties. All of a sudden, with this virus, these are the desirable properties. And hotels, I just put it into the COVID vaccine trade. If there's a vaccine, that's the trade. Then you want to start finding stressed opportunities in. But that's maybe one where more patience is required and monitoring how other things develop. So we have one question, which maybe I'll throw it in here. Is we went through a world, massive dislocation, disinflationary, deflationary fears. As we move out, given the amount of stimulus, the Fed balance sheet is $7 trillion. The ECB's balance sheet is going to explode as well. The Chinese central bank is stimulating, but not maybe as aggressively, and maybe it's reserving some of its firepower. What do you think about inflation? One anecdote we have is one of Lixor's best-selling products is a French inflation-linked ETF. So maybe with that, we see something on our ETF business, but maybe we'll start with Jeff, views on inflation, deflation.
It's tough to really look at inflation risk right now. Certainly a possibility. The thing is that if you look at some of the anecdotes in terms of the price you pay as the economy reopen, even if you go to your hair salon, barber shop, for instance, they would take extra measures to make sure that everything is safe and for people to get their haircut. And that means somewhat some higher price. And you may see some of that anecdotally, but that's more on the anecdotes. But overall, more disinflationary pressures, that's for sure. That said, you are seeing this fiscal stimulus, which means gigantic fiscal deficits, and that will mean some potential inflation pressure and potentially on the rate side. But as of now, I would not be so concerned about it. But it doesn't mean that having some protection in your portfolios are not effective. So one example is tips, which we also think are pretty interesting, is in your fixed income, to diversify your fixed income allocation. You can also think about having some commodity exposure, and here not necessarily just a play on inflation, but that also with the dollar weakening. So having some gold or some silver or some of those type of exposures, just to protect in case of a sudden move higher in inflation. But definitely not something that we're thinking is a immediate risk, but get ready for it.
So with that, maybe I'll transition to Danilo.
Sure. I'm going to start by saying my 2-degree in economics might make me overly pedant in what I'm about to say. So let me set a bit of context in my mind and the way I think of this. Let's go back in time around 2009 when QE1 was started going around. This was the conversation I was having every single time I was meeting with anybody. Okay, inflation is coming, that's the end of it, etc. So we have seen this movie before, where when we're playing around with quantum of monetary easing that we have not seen before, we all get concerned that there is a high risk to inflation. And for as long as I can remember, I always been on the other side of that argument because I looked at a bunch of things. Rate of technological change, which has been extremely disinflationary. Demographics, which have been ridiculously disinflationary. Push to globalization, once again, bringing costs down. And the fact that if you look at the fight between labor and capital in the US, which is really where a lot of this conversation tends to happen, labor had zero negotiation capabilities, like literally none. Every single agreement was going in the way of capital owners, not of labor. Those last two are the ones that right now make me take a pause and go, okay, wait a second, maybe something is actually changing. So I still think from a rate of technological change and from a demographics, you have two massive headwinds, which are going to be very, very difficult to actually overcome. So even if, for whatever reason, I can now build an argument that you are getting some inflationary pressure, we're not talking hyperinflation here. We're talking maybe breaching the upper end of that 2% ceiling, like going 2.5%. In a fantastic world for the Fed and Treasury, because they will love it, maybe you're touching 3%, but that's probably the most you're going towards. And the reason why I say there is a possibility now to go there is because I look at the poll, and one of the questions that which of these concern you the most? 50% US presidential election and 25% China-US tension. Those two tell me that we all lean the same way. The world is becoming less globalized. People are going to have to build supply chain that don't focus on the cheapest availability of your supply chain, but focus on the highest reliability of the supply chain. And that's an expensive proposition. If you're literally buying insurance, so that's what you're doing, you want to make sure that your supply chain is there every single day, you're going to have to pay for that insurance. Like, you don't get insurance for free. So that's going to be costly. And at the same time, you're now going through a situation in the US where between racial tension, between the impact of COVID, and you've had some cohort of workers that really had the non-negotiation power that all of a sudden are the most important one, your grocery stores and so on and so forth. I do see much more social tension, and I see a much better capacity of labor to extract some concession to be willing to go back into a world, especially if it takes long to get a vaccine going. So if all of a sudden owners of capital are going to look at their workforce and say, hey, sorry, this is going to take 4 years, I need you back, I can guarantee you that negotiation is going to be, okay, fine, but you got to give me some money back for the case, because I have all kind of additional costs that I need to cover. So when I look at that, I do believe there is a higher risk of inflation now than there's been in any time in the last 15 years. But it's really more driven by political events in my mind, and much less by other elements that go in the conversation.
Not much to add to all of that commentary. I mean, ultimately, central banks need to continue to print and buy assets, keep rates low until they see the desired outcome that they're looking for in the economy. So they're going to be looking for a return to full employment and moderate inflation. As a result, like that's, yields fall, commodity prices rise. And to Jean-Francois' point, that might be a good place to look for some protection, whether it's tips or whether it is in commodities. I think that it's something that you should be factoring into your portfolio construction.
Excellent. So maybe we'll transition to whether any of you managed to deploy capital during the main drawdown event, which was March. And if you did so, what strategies, assets you deployed into earlier on? And then maybe as you stand today, where are you focusing more of your resources to? And then maybe what I'll do is transition discussion on resources later on. But maybe we can start with Jane on this one. Jean-Francois and then Danilo.
Sure. You know, it was a very interesting time to ultimately be building a program. We kind of had put together a business plan early January, and we're looking to just start executing, and everything changed. Business plan thrown in the garbage, and we started to focus on what can we take advantage of in the short term. You know, to speak to kind of, you know, what we were talking about with what's difficult in allocating during this time, to do a full due diligence, both the speed with which you'd need to do that and the functionality of being able to kind of be on site, we just didn't have either of those options. So when it came to allocating and taking advantage of opportunities, it was a little bit stick to what we know. You know, didn't have a ton of time, like I said. And so the allocations were definitely biased towards assets that we knew well and managers who we were familiar with. And could do, you know, a diligence that would at least, you know, get people comfortable internally. And one area was in the high-grade municipal bond market. Ended up being a big dislocation as a function of fund flows and some of the higher yield municipal bond funds having to liquidate to meet cash demands from people redeeming. And in those cases, you get a lot of technical dislocation in higher grade assets as they have to sell what they can, not necessarily what they should. And so the prices of these higher grade assets gets depressed. And should you be able to take advantage of the opportunity, you know, the credit quality of those assets is quite high. So that was one area we were able to allocate. The other, again, focusing on assets that are not being targeted by the Fed. Convertible bonds are not being purchased by the Fed, coupled with, you know, increased volatility, a big increase in issuance in the space. And with that broad dislocation through March, there has just been a lot of opportunity, more than there's been in a number of years for converts. And that was a great fit for our mandate as well. I mean, convert arb is a very tough strategy to consistently have an allocation to internally just because of the cyclicality. So when the opportunity comes up, to have a relationship with a manager who you can kind of say, you know, what can we do as far as this opportunity is concerned? You know, we were able to kind of set up an allocation there to take advantage of what's happening right now. Longer term, we are looking at private credit. There's obviously a lot of distressed funds being marketed right now. And to Danilo's point, you know, it's going to take a longer amount of time for that to play out. So we are going to spend some time doing diligence through that. But yeah, our focus in the longer term is kind of in the private credit, structured credit space.
I'll just use a few examples. So this was really interesting because you had to move very fast in terms of trying to understand what's going on, understanding what to do into your long-only allocations, where basically even basic equities was a dislocation in itself. And at the same time, this is when you start to work from home and you have to deal with that. So that was really interesting, but I'll use maybe a few examples. In terms of some of the dislocation that we've seen in some of those relative value arbitrage strategies. So in fixed income arbitrage, for instance, you have this trade whereby you own and you do the arbitrage against cash bonds of the run in the US against the relevant future. And so you have a small basis that you're trying to capture. You obviously need to leverage that trade pretty heavily. But as we entered into March, you've seen the short leg of that trade, so the future trade trying to return pretty substantially as investors were rushing to find safety. So that caused the first, and in retrospect, already a warning sign in terms of the dislocation that was going to happen. And then mid-March, you have this liquidity completely evaporating from the treasury market on of the runs, and then you have the long leg that is going down a lot. And so you have this really large dislocation that happened. The Fed come in, targets some of those of the runs, and with as you all know, a very heavy program. This was already the time where basically in a few days you have to go and try to capture it. So some of those managers have been able to do so. Some have been raising assets to do so. And so that was one where basically you had probably a couple of days to move, and then it took probably 3 weeks for that basis to collapse. So that tells you that, you know, some of those dislocations have been very, very quick to happen, and very, very fast also to collapse. And it's in the same area of what we've seen in terms of the liquid public equities, for instance. You had similar trails in dividends I was mentioning, but not going to cover that. But you had a number of those in merger arb also, for instance, merger arbitrage. Can't remember which Monday it was, but you had all spreads blowing out by 10%. And so irrespective of the probability of completion of the transaction, irrespective of the risk, all deals blew out by almost 10%. And so that was another unique opportunity to come in and to capture that spread that collapsed also in a matter of a few weeks. So you had a number of those opportunities that came out. You had to be very fast to capture them. Going forward, structured credit, we've talked about it. Distress is also one place that we are looking at. And obviously will take time. It takes patience. A lot of assets have been raised also, so you have to be mindful of maybe too much money chasing similar opportunities. So you need to find the right partner when it comes down to allocating to that space. But probably distress is really the last leg of that dislocation opportunity.
Yeah, I mean, from our point of view, we are quite a mature pension plan, probably one of the most mature of the different people we have in line right now. And so we really look at our asset mix on a multi-year, being mindful of painful moments like this past March, but really trying to look through those and looking at the long-term performance in the fund. So once you take that approach, a lot of our focus has been really in this kind of situation, focusing much more on the basic data that we have in our mix, and a bit less on, hey, how nuanced and sophisticated can you get? Is there maybe an extra X% in going from this specific kind of credit versus the next one? Sure. Like, are you getting your overall call on credit right? And that's where we have spent a lot of our time in the middle of March, April, and quite frankly, going all the way until now.
Excellent. So some of the comments I've heard so far actually tie up very nicely to the poll results we're getting. In terms of opportunity set, I think most of the people who are coming in feel structured credit, private credit, and then to a lesser extent distressed are the key opportunity sets. Equities and fixed income and rates offer the least. I think we've read this comment where the opportunity set is North America is definitely ahead of the curve. The central bank there is pretty aggressive. The Fed, we know that, offering opportunities on the liquid side. And I think most of business feel that Europe and Asia definitely offer better valuations if you want to find trades there. And then in terms of concerns, I think Danilo brought this out. U.S. presidential elections, which go into full swing in August, September, and China-U.S. sanctions. So again, further things that are bearing on people's mind. So maybe towards the end of this call, now that we're approaching towards the end, maybe one last question for the panel. All of us are working from home, or in some capacity working from home. How have you adjusted your teams and your ability to do due diligence whilst working from home? And maybe what are the pros that you would like to keep, and maybe some of the things you could quite happily ditch and go back to the other ways? Maybe we'll start with Jane, go to Danilo, and then Jean-François.
Sure. I've had a few firms set up a broad-based virtual operational due diligence day, which I thought was actually a pretty good way to quickly introduce a lot of the people with regards to the ODD side of the business and give access to resources pretty quickly. There's been a lot more setup of data rooms, so just giving us the autonomy to do a lot of our diligence and prep, from home ahead of time. The type of thing that would normally happen, I think, in a first meeting in person, you are just doing it kind of on your own and then coming back with a list of questions after. It's hard. You lose a lot of, the intangible items that you pick up in a conversation with someone. Understanding culturally how they'll fit with your organization. If you want to leverage that relationship for more than just the return stream, if you want to have a bit of a partnership and information share, it's very tough to assess that without, I think, meeting someone in person and seeing physically the culture of their office and how they interact with employees and things. So I'd really like to keep, the information that's being sent, soft copies being sent ahead of time, the data rooms that are being set up. It's very accessible. It's very easy to check on issues and do a lot of the research ahead of time. But for new relationships where it's not somebody that we've met before, I think it's very difficult to have full confidence in the firm without having that in-person meeting and without being on site, just to get a sense of the intangibles and kind of what that relationship would look like going forward.
So I think I wholeheartedly agree with pretty much every single thing that Jane has said. It will be a waste to get a great crisis go unanswered and not actually trying to learn what you can do better. And have a frank conversation with your stakeholder internally and trying to figure out, okay, are there ways where we were really stuck in the past in the way we were doing it and not looking at new ways to do that? And I definitely believe, in general, as a locator, we over-relied on the in-person meeting. Having said that, if you are in the locating business, you are in the trust business. And building trust over Zoom or whatever other software you use, it's virtually impossible for me. So I actually believe we're going to have some adjustment. I actually believe a lot of people are probably going to rely a bit more on consultant and get on a network of on-the-ground consultants globally to complete ODD and to a certain extent even IDD when needed. But ultimately, there's still going to be a hardcore number of in-person interaction you're going to have. And I do worry, as Jen was saying, I think many people have been fairly comfortable in deploying capital into people that they have met before or they have had a relation in the past and so on and so forth. But the more times go by, the more likely it's going to be you're going to have to put money in somebody who's brand new to you. And I think we have all been willing to bend slightly our rules to make them work for somebody who we trusted ultimately. But what's going to happen when you have to allocate money to somebody that you don't know yet if you trust them or not? And so that's going to be, again, kind of dependent on how long this goes through.
Yeah, we are in a kind of it's investing, but it's allocating to external managers. It's definitely a people business. So and it's also true internally. I've been kind of impressed in terms of the way we as an organization, which is global, with offices obviously and headquarters in France, in Paris, the way people have been trying to adjust and interact with each other, where we've set up a number of investment committees on daily communications, and the amount of sharing that we've had between the teams, we never had that. So this I would definitely keep. I think it's been also helping a lot into the investment decision process, and in particular in some of those days in March where you had to take sometimes pretty difficult decisions, and sharing as much as you can with your colleagues, I think has been great and clearly helping. In terms of looking forward, it's true you want to keep that more sharing and more efficiency in some of those projects, but for new projects which are more complex, for new relationships, both on the manager side but also on the investor side, there is nothing that will replace in-person meetings. So this, I think, needs to come back to normal, and we won't be able to kind of get to where we were before until we get this health situation solved for real. Last thing, I would definitely keep the fact that I've been playing football or soccer for the American with my son, and I'm hoping that now he's going to be like a big star, and maybe I won't have to bother with what's going on in the markets going forward. So this I would definitely keep the training.
Excellent. What has impressed you the most in terms of managers, without naming names, but things they've done which you were like surprised, wow, I'm impressed with what this individual has done, in terms of whether they've reached out voluntarily, offered up things, gone through analysis, implemented technology, anything. Maybe we can start with Jane and then go to Danilo and Jean-Francois.
I think people are being more open right now. So just their willingness to share information has been surprising in some ways. I think that there's been some data sets that maybe would have taken a bit of coercing to get that have been a bit easier for them to send over for us to do a bit of analysis ahead of time. One thing I kind of had in conversations now and going forward, I think that as we kind of do make this process more efficient as far as meeting managers and starting that relationship, I can see that there's going to be a lot more travel on the manager's part. I think that as we do return to travel and that being a bit normal, and we've all realized how work from home is possible, I still think that there's going to be a hesitant from organizations to be sending their people globally often. So I could see that going forward, managers having to do a bit more travel, and the few conversations that we've had, and people seem amenable to that. So that's one change that I do see coming as well.
So this is going to be one where I'm actually going to disagree with Jane. And I had a conversation with one of our long-only equity managers recently. And this person used to travel to meet investors and used to travel to meet companies that they're invested in, so their portfolio companies. And he just was going over and over how his productivity has never been this high, because he doesn't have to travel. And so he was adamant that no matter what, he was going to figure out a way not to travel ever again. Now, I think he was being overly aggressive and optimistic that he can get there. But I think collectively, we're probably going to see a lot of business plans that are going to go more in that direction. And so actually one of the questions I was in the Q&A, what best practice would you like to see more from GPs? I think we're all going to have to get used that a large use of video conferences are going to come in, and they're going to be part of the IDD. And I think there's going to be a large portion of processes that used to be done in person that now we need to get our head around of, it's way more efficient doing a lot of those meetings in a VC context, in a video conference context. And then you're still going to need one or two touch points, but they're going to be one or two touch points. They're not going to be 6 or 7 as they used to be in the past.
He must be very confident in his investor base.
He was.
So maybe I think we've gotten some questions. So I think Danilo addressed one, but I think in the interest of time, I'll try and get this question in, which is maybe around the US-China tension or Western Europe, developed markets, China tension, because the China tension is most egregious or more advanced in the US. But I think even in Western Europe, you're seeing people push back against China. Germany has a new law in saying, look, if you're going to acquire German companies, the government has a veto right, which all those things are really geared towards China. The UK has a tiff with over Hong Kong. So maybe to the panelists, how do you view your investments in China today? Think the tensions dominate, or do you think there's opportunity there that you should invest in right through the volatility of the tensions?
I'm going to take a stab at that. I think I said it earlier, the level of diversification you're going to be getting going forward from investing in different markets, I think is actually superior to what you've got in the last few years. So from a fiduciary point of view, I cannot ignore that. I need to look at that and I need to go after. The problem is now the risk in the past used to be very VAR-like in nature. Like, all of a sudden you might have some discontinuous event that gets you name it, whatever equity market somewhere dropping 30%, and that's going to hurt you a lot in your diversification. But that's really what you were going after. Like, you were going after markets moving at their own idiosyncratic pace, because you know that the collection of idiosyncratic risks is going to be better than 2 or 3 idiosyncratic risks. So that's really what you were going after. The risk now is that one morning somebody wakes up and says, yeah, that investment is mine. And so like you're looking at a bunch of zeros in those situations. So the risk of nationalization on one case, and on the other, preventing you from investing, and now that money is stuck somewhere and you can't move it anymore. Those are extreme risks that have much harsher implication on your portfolio. So I think on one side, you can't ignore diversification, you need to look at it. On the other, you better be aware and able to manage those discontinuity points, which are quite extreme right now.
No, so just on the diversification, I was reading, I can't remember, I'm sorry if it's someone who is on that call, but why don't you own a little bit of everything? I think it's really a good way to look at it, and yes, diversification will matter in terms of regions, in terms of sectors, and when you look at it from that angle, you really have different dynamics happening, and you can't ignore that, and that's diversification benefit. Probably more going forward. So totally agree on what Danilo said just now.
Yeah, no, I completely agree with all of that. I think that global diversification in your portfolio is going to have a larger impact and going to become more important as we move forward, to both of your points. And it's very much a regulatory risk that we're up against with regards to those tensions and how things kind of play out in the next little bit. And regulatory risk is very binary. To Danilo's point, it's on one day, it's gone the next. And so it'll be interesting to assess, if there's any difference in the risks with regards to liquid assets versus private assets in the region and how those could be managed. But ultimately, I think that, regulatory risk between liquid assets or illiquid, it is, shut off the same way. So you just have to be very cautious.
Excellent. So maybe this will be the last question. What do you think that trading advisors or GPs have done that they shouldn't do? Some of the dislikes, maybe we can go through that.
I've seen people panicking in March. People didn't expect to panic. That's not a good sign ever. Like I want to know you control the process. I'm okay understanding you're going to lose money, but like when I lose confidence in your mental health, that's a tough one.
Yeah, I think the communication for the most part has been really good and actually improving. The very few sometimes be able to talk to some of your managers in the midst of all those tough times was a bit of a challenge, but it's a very a minority of managers. But overall, it's been actually a really good experience, and it's been helping us also in terms of talking more and getting views and avoiding actually that kind of panic that you can see when you go through this type of market turbulence.
Yeah, I would agree that increasing communication during those volatile periods is extremely important. If the markets are taking all of your attention and taking you away from your investors and that communication line breaks down, it just builds anxiety and builds distrust. So increasing communication is, definitely worth the time and effort.
Excellent. So I think maybe with that, I don't see any more questions. Maybe we can wrap it up. I want to thank all the panelists, Jane, Danilo, Jean-Francois, for their comments and also taking the time to be on the panel and going through this with us. So again, thank you very much.
And that is going to conclude our session for today. Thank you so much for participating. And we look forward to seeing you at future webinars in our series from Talking Hedge Events. Good day.